The global money supply right now standing at $116 trillion, the blue bars showing it's growing at an 11% annual rate of change. That's a solid expansion of money in the global economy. Central banks' printers are running wild. All of this leads to something called monetary inflation. More money to spend means more money is being spent, and that leads companies to raise prices. Historically, in response to that, gold prices rise. One of gold's major features is being a hedge against really bad inflation. We saw devastating inflation in the 1970s that heavily affected markets and economic performance. And gold surged sharply in reaction. Right now, we're looking at whether this scenario could happen again. Inflation could spike, and gold has already had a spectacular rally. The current price of gold is around $5,000 per ounce. And the same applies to other precious metals like silver and copper. Central banks cannot print more gold, or any other commodity. Commodity supply, unlike money supply, is limited by nature. This chart of gold price and M2 money supply highlights a major shift happening right now. The global spheres of influence are changing.
At globalized, we're always focused on providing you with outstanding analysis. However, none of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content.
The global landscape is increasingly shaped by the strategic positioning of major powers such as China, Russia, and the United States. How these blocs align and trade with one another affects everything from energy costs to food prices to industrial inputs. While the US dollar remains the dominant reserve currency, accounting for roughly 55% of global reserves, its relative influence is gradually being challenged. Gold in particular is gaining importance within the China-Russia-India sphere as an alternative reserve asset. At the same time, we're seeing geopolitical realignment through new trade agreements between Europe and Asia. While US policy is increasingly oriented toward reshoring and strategic decoupling, rather than deepening globalization. We're seeing these global spheres of influence settling into a fragmented position. The world is gradually de-globalizing. Globalization began decades ago with countries cooperating. Lower labor cost regions like China or Vietnam provided capital-rich economies with inexpensive labor. Capital is substitutable. Labor is substitutable. But commodities are not substitutable. This is the global price index of all commodities. Historically, the global commodities index tends to lead US inflation, especially around major cycles. You can see it in the mid-2000s run-up, the 2008 spike and collapse, and most clearly in 2020 to 2022, commodities surged, first inflation followed with a lag. Commodities are upstream in the production chain, energy, metals, food. So sustained moves there eventually filter into producer prices and then consumer prices. Right now, the key issue isn't just that commodities and CPI have moved together before. It's that the global commodities index has resumed an upward trend and remains elevated relative to pre-pandemic levels, while US inflation has come down from its peak but is still above target. If commodity prices continue rising from here, especially energy and industrial inputs, that creates upside risk to inflation stabilization. Even if headline CPI doesn't spike immediately, persistent commodity strength makes it harder for inflation to sustainably return to 2%. The structural layer matters as well. In a deglobalizing environment, supply becomes less elastic and more geopolitically sensitive.
None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is globalized.